One of the key things that we sort of worry about are the elections, what's going to happen with Fed interest rates. For those who saw the news late last night, interest rates in America are still going up, and therefore what does that do to flows into India, and therefore what does that do to equity prices? So let me talk a little bit about how quantum AMC handles this issue of uncertainty out there. Let's look at the triangle first. So we believe that from an asset allocation perspective, investors should be somewhere in that triangle. If you go to the base of the triangle, you get the risk-less asset of quantum liquid fund, where you're buying effectively government-issued bonds and some quasi-government bonds. At the tip in the green is your crypto and whatever else you want to do, which we don't understand and don't really how to explain it. Then, of course, you've got the small cap fund, then you have mid-cap funds, etc. And then you've got, from our perspective, we're talking more about the long-term value fund, which within the equity, within the risky class of equity, in our view, is one of the least riskiest assets out there. And I'll explain why. 2008, I asked a few of you all where you all were in 2008, September 15th, when Lehman went bankrupt. Many of you all were still studying. Some of you all were just about working. So the heads of states, G20, finance ministers, central banks, presidents, prime ministers met. They were completely clueless on what was going on. They didn't have a solution. If you had spoken to Quantum Long-Term Equity Value Fund in November 2008, we'd have told you that if you invest with us, in 2 years' time, you'll make a return of 158.6%. That was a published forecast, audited. And by November 2010, the blue line, we did a little better. We gave you a return of 179.3%. So Lehman's gone bankrupt, the world's at risk, banks are going bankrupt, no one has a clue what's happening, and Quantum says, don't worry, stay invested with us, and we'll give you that rate of return. So what is it about quantum? What is it in quantum that in periods of uncertainty, we're able to talk with such certainty? So this is something we call the upside potential chart. We have with us Mr. Malay, who runs our compliance. So he's to make sure I don't make any wrong and incorrect and false statements. So this chart, this is what you saw at Lehman time, 2008. We look at the value of our portfolio today, and we can estimate the NAV, the gross NAV, if you will, a gross value and the net value 2 years out in the future. And that's what the chart looks like on a running 2-year basis. And the blue is what we actually did over that same time period. And let me give it to you in a linear format. So what would a 100 at the start, when we launched our fund in March 2006, we began forecasting for what will happen by 2008, and the blue is what we actually delivered, and you can see the tightness of that fit. The deviation of COVID, the deviation of Lehman. Out of roughly 180 something months, there were 11 months when we were not close to forecast, which was here and here. Lehman as a disruption to equity markets and financial markets lasted only 6 months. From September 15th, when Lehman went bankrupt, till March 6th, 2009, when green shoots appeared and stock markets, financial markets reacted worldwide to those green shoots and equities went up. COVID lasted literally 5 months in terms of financial markets. Humanity took a couple of years to recover with all our vaccinations phase, jab 1, jab 2, jab 3, jab 4. But markets recovered the minute the lockdowns were first lifted, so June 30th and thereabouts. And the minute there was efforts towards vaccination, financial markets took off. So these were the 11 months when we were sort of off, if you will. But then we caught up very quickly. We were off over here, but we caught up very quickly by the blue line of what actually happened on NAV, caught up with the upside potential line. And what is it? What is this clarity of thought that we have which allows us to do that? So with a team of research analysts, we go out and meet companies. We study sectors. We visit factories. There's no AI behind this. It's human effort. Okay, collectively, as a group, we spent about 6 lakh human hours on building these databases since the year 2004. So what do we actually do? We go out, we meet a company. If we believe that the company's intrinsic value is 100 rupees, is worth 100 rupees 2 years in the future, FY2E, we ask ourselves the question, can we get that stock at 75 or less? At least a discount of 25% to that intrinsic value. So if we are right, what will happen? The 75 will become 100, right? We'll have made a return of 33.3%. And if you annualize that, because this is over 2 years, if you annualize that, it's 15.5%. It's simple mathematics in that sense. So let's assume we own HDFC and we own the stock and it's worth 100 rupees today in the market. And our sell price, our intrinsic value is 150. And let's assume that we have a 2% weight in the stock. So if we are right and the 100 becomes 150, that's a profit of 50%. And we have a 2% weight. That means we make 1% for the portfolio. If we do that for every single stock, every single day, every single month, we know the sell limit, we know the current price, we know the market weight, we know the weight in the portfolio. Share prices change every minute, weights change accordingly. Our sell limits change twice a year or so when we review companies. So that's the mathematics behind it. And from that 15.5%, keep that in mind, the actual return of the NAV has been 14.1% because we have expenses. You see how close we are to that, okay? And this is what the estimated gross returns were. Because when we look at the estimates, we're not looking at costs, we're looking at the gross value. So that's the background of what we've done in terms of trying to ride over uncertainty that may exist in markets. We have a very disciplined process in the value fund. Who are the people behind the firm? What is their philosophy? Are they just gambling, risking, taking chances? Or do they have a structured philosophy in mind? In our case, long-term sensible value. And what's the process that they have which lets you convert that value philosophy into something repeatable? Right? When you buy a car from Maruti or BMW, and if the car factory has got 1 million cars capacity in a year, you don't call up Maruti or BMW and say, which car did I get? Did I get the first car, the 5th car, the 100th car, the 1 lakh car? Because every car's got a certain process, it's built by process. We built a portfolio around process. And having built that process, what is the outcome? So Vanguard taught me about a trend line, about a direction. We took that direction and made it into these monthly points, as I indicated, on upside potential. The history of Quantum, as Reena indicated, we've been around for a long, long time. Subbu, the important milestones. Subbu joined Quantum in 1996. That's the year when I broke off from my joint venture with Jardine Fleming. And we put in place something called the integrity screen. The integrity screen allows us to avoid companies who are bad actors in corporate governance and otherwise. They're not good businesses because there are certain issues we have about the ranking of the integrity screen. So we avoid them for that. And of course, we got our license from SEBI and we launched the first product, the Quantum Long-Term Value Fund, in 2006. So those are the 3 key milestones for Quantum. We're a small fund house, but we set the pace for a lot of things. In 2006, we were the only fund house to go direct to investor. We did not use distributors at all. We were the first only fund house to have an only direct plan. SEBI forced everyone to have a direct plan in 2013, I think it was. There it goes. So things that we've done, SEBI has done 3 years, 5 years, 10 years later, and made it into custom and good practice for the industry. So that's us as a group. This again just shows something else, that when you invest in stock markets, you expect returns. Why? You're investing in India's growth in GDP. And when there's more economic activity, that's GDP. Or more economic activity means companies are having more revenues, more activity, more sales. If companies have more sales, they have more profits. If there's more profits, stock markets go up. It's a direct one-to-one correlation in the long run. And India's got this fabulous chart of stock market returns and GDP in nominal terms. Fabulous chart. That's where foreign money is coming in. Why are foreigners leaving their home country to come to India, or when they went to China? Because they wanted to chase GDP growth and stock market returns that come with it, or anything. Real estate goes up, everything goes up in an economy that's active. In an economy that's dead, those asset classes don't rise that much at all. So so this is a very good chart and a very positive for India. Let's talk about why being invested in the market makes sense. So we know there's a valuation issue. We recognize people are concerned. Let's look at history, let's a bit of history here. Starting from 2007, the average PE ratio of the market is 14.8. The high has been 22 nearly, and low has been 8. Around Lehman and COVID were the lows. And the quantum long-term equity value fund, when we look at our own portfolio and look at the PE ratios of that, it's less than the market. So one is, you can see consistently that while markets may be expensive, the long-term value fund, by its very nature of valuations and being concerned about valuations, is less expensive than the index. And is it more expensive than its history? Yes. If I was to put a line here for our PE ratio, it probably will be in the 13-ish numbers. So yeah, we are more expensive than our history. But does that concern us? Not really. It's not what it was like after COVID and after Lehman. Clearly, it was not like a fire sale where you can get great companies with great intrinsic value at low prices. Let's go back in history again. From many of you all interview fund managers, analysts all the time. Every year since 2013, at the start of every year, let's take one random year, the orange line of 2017 March. In 2015 and 14, when the research analysts began estimating EPS for the BSE 30 index companies, the estimates were up here at 2,300 rupees or so. Every quarter they reduced, and the actual number was somewhere close to 1,400. If you were running your company or you're running your news stories and you tell your boss at the start of the year, I'm going to give you 100 articles in the course of the year or 100 interviews on TV, and you give only 50 or 40, what will your boss do? Probably fire you, right? These guys, I don't think these guys got fired. And they did this year after year after year. These are the estimates year after year, every year, like a ski slope. You begin optimistic and you go down. Of course, this was COVID, March 2021. So you can't blame anyone for that. But look at all these other years. And what this also tells you is, while Prime Minister Modi was in power, if you drew a trend line of earnings per share growth, barely 6, 7, 8%. And in the long run, stock markets reflect EPS growth. If there is no EPS growth and if markets go up, that's a bubble. Right? So if there's no EPS growth and markets go up, you saw the previous chart, the PE ratios went up. What we're seeing now, which makes us a little more optimistic and comfortable than the past, is look at the sell side analyst estimates now. They're beginning low and moving up, beginning low and moving up. We did not agree with these high numbers. We agreed with the low numbers in the past. Now we're of the view that something's happening in the economy. There is movement. Things are going to happen. And therefore earnings will look better than what they did in the past. And stock markets move on earnings. They may be rattled for a while by change of government, elections, results. They may be happy, they may be sad, that's different. Eventually they move on earnings. And what we're seeing from our own research is an agreement with this trend that earnings are going to be increasing. Do we worry too much about election results? Yes and no. We believe that investors should be in the markets for decades. And this is a chart going back 500 years. The late Angus Madison prepared this chart to show what global share of GDP was of different continents and different parts of the world. So in the year 1500, the United States didn't exist. And China in the red occupied for about a quarter of global GDP, and India in the gold occupied another quarter of global GDP. And over time, things changed. We had the Industrial Revolution. So Western Europe, in the blue, became larger. The United States was born in 1776 on the top. They became larger. And India and China both looked inward. We became socialist, they became communist. They killed a few 100 million people, we just killed a lot of activity in our economy. And you can see how we shrunk, China and India. And then of course we had the reforms over time. Socialism in India opened up to a little more market-driven economies. China said, very famously, Chou Enlai said, we'll signal left, but turn right. And they opened up and they joined the WTO. And China's economy grew, and this is our forecast of 2050. And India's economy as global share has also grown. And Europe is the old dying man. Japan is the old dying man. The US is aging. So that's what's going to happen. And of course, all other countries, including Africa, are going to be increasing over time. So the tailwinds for your children and your grandchildren is fantastic. It looks very good. So don't look at markets on a monthly, quarterly NAV basis, please. Please look at things on a very long-term basis. And let's look at this chart, which is in the black line, we have GDP of China, and there, the black line, GDP of India. The green line is stock market returns in China, indices, and the green line is stock market returns in India, MSCI China and MSCI India. What do you see striking in this chart? I told you something about economic activity and stock market returns. Well, China's got economic activity. Where are the stock market returns? India's got economic activity and stock market returns. What happened in China? What happened in China? Strong governments. Jack Ma, he has a company, listed company, and financial, what's the other company's name? Alibaba. He doesn't own Alibaba anymore. The government decided to take it away from him. Remember BRIC? Brazil, Russia, India, China. When Sir Jim O'Neill gave the idea of BRIC in 2003-04, it was a crazy idea. It was meaningless. It was a marketing gimmick. Nothing common between Brazil, Russia, India, China. Nothing at all. But in 2022, Sir Jim O'Neill was right. There was something very common about BRIC. One very, very commonality was the kind of governments that each of the BRICS had. Brazil had President Bolsonaro, who was ousted from office by the end of 2002. He was president. Russia has Putin, and China has Xi. And India has Prime Minister Modi. And the three strong men made sure, if you look at the graphs for Russia, they're identical. Look at the graph for Brazil, there's a break. Look at the graph for Turkey, there's a break. You've got GDP activity, but don't have stock market returns. But in India, we're blessed that we have a very good government and we have stock market returns that are moving with the index. So in summary, let's just talk about what people should be doing with their allocation, how they should look at elections or other uncertainty. So there is a triangle as we indicated in the past. And you go up the triangle, you take more risk. And if you take more risk, you should deserve more return. And also, if you get more return, recognize you've taken more risk. Principles of investment 101. The more return you seek, the more risk you have to take. The more return you've received, the more risk you've taken. Known or unknown, you've taken a risk. And what we've done from our perspective in quantum is try to, as you saw from the charts of predicting and estimating what will happen during COVID and during Lehman going back to 2008, we've taken away that risk with a very clear objective. How do I invest in a company with an intrinsic value of 100 in the future, 2 years from now, and can I buy that stock at 75? And when Lehman collapses or COVID happens, does that change that intrinsic value? And if it does, I adjust that. But it doesn't change it much most of the time. And if it does, we take it out of the portfolio. And that's what we've been able to do. During uncertain times, over all these environments, growth versus value, technology versus everything, AI coming up, strong rupee, strong dollar, weak rupee, weak dollar, high interest rates, low interest rates, doesn't matter. We know how to navigate this stuff. And then, as I indicated, when you're in uncertain times, you look for those funds or those stocks where you find valuation in them, which is less than the market. So today what we have in the Quantum Long-Term Value Fund is we have a trailing 12-month PE of 21.6 high, but less than that of the index, which is 24.4. So we're 11% less expensive than the S&P on historical trading basis. And if you look at the future estimates that the sell-side analysts have on the stocks we own and the sell-side analysts have on the BSE 30 index, we still look attractive on various things. Our weighted PE ratio looking out is 16% cheaper than that of the index. That this calendar year assessment of looking at a fund is ridiculous. 3 months, 6 months, 1 year, 3 year, 5 years, 7. These are like man-made years. They're meaningless. What you should be looking at in a fund is how it's performed over different cycles, over different phases. So when we look at the market, there are different phases in the market. So a cycle is when you start, you go up and you come down. But that's 2 phases. And as a value manager, what you should be doing, I don't know if I have that chart here, yeah. As a value manager, when the markets are going up, so let's take this bull phase. We spoke about green shoots on 6th of March. So 9th March 2009 till roughly 2010 for about a year and 6 months. In that period, the Quantum Long-Term Value Fund was up 189%, the BSE 500 with small cap 189%, BSE 30 164, BSE 200. So we captured upside. And when markets went down between November 2010 and December 2011 over 13 months, we were down 20%, less than that of the market. So we protect the downside. So if you capture the upside and you protect the downside, you over time, you can outperform. But if you start looking at quantum or any fund on 3 months, 6 months, whatever they do, 1 year, 3 year, 5 year, useless data, completely useless. It doesn't tell you about the characteristic of what you're buying.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.